was out last week, so it's been 2 weeks since I've done a broadcast on the market. So it was traveling, so it was just too difficult to do a recording on the road. But I'm Ben Reppond. Welcome to my YouTube broadcast. Today is May 17, 2023. We'll get into start with the dashboards. This is as of Friday, this past Friday. And the market this past week was generally more negative than positive. And so I show you the last week in yellow and in pink, the year to date. So it's interesting. You can see it's sort of a bifurcated market. I mean, you've got three indexes: the NASDAQ 100, the developed markets, and the S&P, all doing pretty well, especially the NASDAQ 100 and the foreign market, developed markets. All of those are green, above their 20, 50, 100, and 200-day moving averages. Then you drop down, and all or nearly all of the others are all below their moving averages. The 20-year government bond, struggling. That tells you that interest rates are going up, which means bond prices, generally speaking, are going down. Emerging markets, weak. The Dow Industrials, weak. And the Russell 2000, definitely the weakest. So after you get past the first few, looking year to date, you get past the first few indexes. After that, there's barely any gain this year. So you look down at the emerging markets, Dow Industrials and small cap, Russell 2000 small cap, they're barely, they're kind of break even for the year. So definitely two different stories. When you take the NASDAQ 100, when you take the S&P 500, you break it apart and look at the component parts. Again, it looks kind of the same way. So you have the top three measured on a year-to-date basis, especially the top two, the technology and consumer discretionary, up 21% and 14%, and then consumer staples up 3%. After that, it's either barely positive or it's negative. So the rest of the market is struggling. So the broad market is definitely weak, and it is being held up by, frankly, just a few technology stocks, and the consumer discretionary has also done very well. But those, if you remember from last year, throughout all of last year, it was the exact opposite. So the worst one here, energy, was up a lot last year. At one point, I remember seeing 64% gain. Now it's in the basement. And what was in the basement was consumer discretionary and technology, and now they're on top. So everything just kind of flipped around. But a lot of them are, as you can see, a lot are, other than the top three, a lot are negative, below those moving averages, or barely above them. The general direction of the S&P 500 since October has been positive. However, at the end of this, on the far right, you can see that that tick down is actually 2 weeks worth. For the last 2 weeks, it has pulled back a little bit. But I would say it's still the intermediate term direction of the S&P is in a positive direction. The growth versus value. This has been interesting because last year, almost all of last year, the growth was out of favor, value was in favor. If it goes down, that favors value. If it goes up, that favors growth. And however, beginning in the first part of January, you can see from the black arrow, you can see that growth has been outpacing value, kind of going the other direction now. And our investments, we got in January, and we have been most of the time in growth. We got out of the market briefly in, I think it was late February or early March. But and since that time, we've been in growth. So we've been participating in this move up, and that's definitely helped our performance. So anyway, for the short-term view, it's positive for growth at this point. Okay, now this is interesting. So growth, definitely going up, but look at this. The S&P 500, large cap stocks, the largest 500 companies, relative to small cap, the Russell 2000, IWM is the ETF. Relatively speaking, look how large cap, S&P 500, has outpaced small cap. And you saw that on that first dashboard. The bottom one was IWM Russell 2000. It is definitely negative and been struggling. Meanwhile, the S&P 500, led by a lot of large cap tech stocks, has been surging. So this is not going to last, but it's interesting that for now, both growth is in favor and large cap is in favor. The long-term government bond fund, ETF, TLT, has, since it hit a bottom in October, has been struggling and has kind of started to almost come down a little bit. So it looks to me that this probably is got more of a downward correction to it in the future before it heads back up. But that would say that interest rates are probably headed up, and for the intermediate term, and that would therefore force yields up and bond prices down. The dollar has, the US dollar is the strongest currency in the world, and you may, by far, and it's the reserve currency. So we could talk about all of the things that cause the dollar to be weak, the countries that are using other currencies to do business rather than the reserve currency, the US dollar. Those would all be correct, but it is still the strongest currency in the world, and relative to other currencies. It, however, has come down since October, and the short-term trend for the dollar is down. But if it's down, the currencies from other countries are probably in worse shape. Okay, gold since October has been definitely moving up, and it has been more stable and more consistent than silver has been. Silver has been, had some more volatility associated with it, but gold has been definitely in an upward trajectory, and that is, in my opinion, kind of a flight to safety. Silver, same thing, on its way up, but last week had a pretty big pullback. So you see the volatility in silver, and gold less volatile. But that's historically, that's always been the case. When you compare SLV for silver as a numerator, gold, GLD as a denominator, you can see that it shows silver even weaker on a relative basis. So I didn't put any arrows here because I don't see a pattern. It's going up and down a lot, but that's the 12-month view of silver. Bitcoin has been going up. The short-term direction is positive. However, it has pulled back in the last couple of weeks a little bit, but it kind of hit a bottom in November, December, and now is moving more in an upward direction. Volatility. Now, volatility is if it is down, that is positive for equities. So, meaning the market is less volatile. When the market is riskier and then volatility increases, and the volatility index, the VIX, the VIX, moves in an upward direction. I put my arbitrary line at 24 to show where that threshold is, in my opinion, where as long as it's below that, it's positive, particularly if it's moving down below that. And it does seem to be moving down below that. So this, again, signals to me a positive view for equities, at least for the time being. Because of the negative, slightly negative view of equities in the last 2 weeks, Asbury Research has gone more negative. They have 4 of their indicators that are negative and 2 that are positive. 2 weeks ago, when I did the last broadcast, all 6 were positive. So this is signaling more of a caution, at least for right now. But as you could tell from the charts, my view is that for the time being, through last Friday, the charts are saying that it's probably good, at least for now, to be invested in equities, and particularly growth in large cap equities. Okay, the cross-asset relative performance chart, this is a relative strength chart, done by Asbury Research, where they compare numerator, denominator, comparing a number of factors. So low volatility stocks are more in favor than high volatility or high beta stocks. Large cap is more in favor than small cap. We definitely talked about that. The broad market is stronger than the Dow Industrials, and we've seen that also through the data. Technology, the NASDAQ 100 is more in favor than the S&P 500, and it was about a week or 2 ago, I don't remember the day, but at that point, through, I think it was a week ago Friday, that I read some data that said that 8 stocks, 8 large cap tech stocks, you probably guess who they are, had all of the gains of the S&P 500, and the remaining 492 stocks as a group were negative for the year. So you take those 8 stocks out of the S&P 500, and the S&P 500 would be negative for the year. That's how much those few stocks are holding up the market. And that shows here with technology being stronger than the S&P 500. As I said, you saw the chart on this. Growth is more in favor now than value for both the weekly, the monthly, and the quarterly view. And the U.S. is stronger than emerging markets. Emerging markets, as you remember from that first dashboard, was really toward the bottom. I think it was next to the bottom. So they are struggling, but I think the longer-term view for emerging markets is positive. But for right now, the U.S. is stronger than emerging markets. And then corporate bonds are higher. High-quality corporate bonds are higher, or stronger than high-yield, low-quality bonds. This is interesting. It's been over 6 months since the U.S. had one green box that was strong enough for one green box for the weekly, monthly, or quarterly view compared to 21 countries and 3 regions of the world. This week, Japan and 3 Latin American countries are stronger than the U.S. Nothing wrong with Japan, nothing wrong with Latin American countries. But the U.S. has been the engine that's driven a lot of the economy of the world, and certainly from the consumption standpoint, but from the stock market standpoint, it is struggling relative to these other countries. I took Mexico, one of those countries, and just put it on a relative strength chart to show you Mexico numerator, US SPY denominator, to show you what that looks like. This is the degree to which Mexico has outperformed the US since August of 2022. Interesting. Gold and silver, this is spot prices. As of Friday, the gold was down 0.3%, so slight tick down, and at $2,017 per ounce spot price. And silver, 24.14, was a decline of 6.5%. You remember on that silver chart, I showed you that sharp decline at the end? That's a result of this, 6.5. That's caused the gold-silver ratio to go up to 83 to 1. I think it was 78 or 79 2 weeks ago. 83 to 1. That definitely favors silver as being a better value than gold, and anything above 40 favors silver, in my opinion. My son, Preston, gives me this data, a monster box of silver bullion. This is not silver eagle, so bullion, generic, what I call generic silver, is 500 coins to a box, or 500 rounds, 1 ounce rounds to the box, $14,230. That includes the markup on top of spot of $4.32 per ounce over spot. So for the 500, including the markup, that's $28.46 per round. If you buy a sleeve, a tube of 20, it's $28.96 per round. Bad news. If you continue to spend what you can't afford, you run the risk of being elected to Congress. I'll leave it at that. Thank you for watching. If you have any questions or comments, leave them in the comment section below. Thank you.